Summer is slowly but surely working through its latter innings. Although you wouldn't be able to tell by looking at the stock market, where people seem to be quite complacent and maybe somewhat confused. Nonetheless, this means I have a little bit more time for a couple of more paddling sessions on the lake. I've had a good summer. I spent quite a bit of time in Italy, then I used my new mountain bike to its full extent in the Alps. I came out with my new trend following course in the month of July, which has been a great hit and continues to be absolutely gobbled up by you guys. So thank you for that, and I know it's been helping a lot of folks. I'm getting a ton of positive feedback. But as the summer winds down, what I'm seeing is a lot of people are getting quite complacent as far as investment goes. I'm seeing a lot of people ask less questions. If you look at the market volatility, it's been extremely low. And I think this is actually a time when people really should be paying attention to the markets more so than ever, because there's always a good chance that we see a spike in volatility at some point in the September to October period. As far as the broader stock market goes right now, we are seeing almost unprecedented low volatility, a lot of complacency, and like I said before, I think it's a lot of confusion in the market right now. So from my perspective, as much as I remain positive from a sector rotation and group rotation perspective, and for plenty of single name stocks, I also think this is a great time to start buying a little bit of protection, maybe via some cheap S&P 500 puts, or even some plays in the VIX looking through into the October period. So this is not a period to be complacent, but rather a period to play the market, manage it right, and understand that at some point over the next 1 to 2 months, there tends to be some sort of spike in volatility.
All right, so let's look at some charts to gain a little bit of perspective. I remain quite constructive on stocks and risk assets in general through the intermediate term lens for the time being. And one of the reasons for that is because we're seeing a lot of risk assets like high yield, emerging market bonds, and of course stocks continue to sort of climb the wall of worry, for lack of a better term. At the same time, within the U.S. equity space, we've continued to see rotation over the past few months in stocks, stock-specific groups, and sectors such as financials, such as transportation stocks, and most recently, even some housing-related stocks and ETFs. And that sector rotation and group rotation is quite healthy until, of course, it starts to break down. So for the time being, to me, that's quite constructive. What I'm advocating here is to buy some cheap S&P 500 puts for protection as we're starting to slowly get into a historical period from a seasonality perspective, late August into late October, let's call it, where we tend to see some sort of spikes in volatility. Doesn't mean the market has to fall apart, but that's why I think right now, considering the very low implied volatility, as you can see here on the VIX, coupled with the seasonality, it's important not to get complacent. A lot of folks, like I said before, I think are getting complacent. They're not really, looking at the market too closely, not asking me a lot of questions. They're not really looking to invest in the investing, trading, education. And I think right now is the actual perfect time to do that. So look at the VIX. I just went back for the past 3 years to keep things very simple. You can see implied volatility spikes in September, October 2013, again in 2014. And last year, of course, we had a big spike in volatility in the August period, and that spike really lasted through early October. So we never know exactly when that spike comes, but it's a prudent thing to do here to buy a little volatility. I will show you guys one or two more things. One is bonds. You see bonds have continued to consolidate. This is the TLT ETF, have continued to consolidate here above what used to be resistance in 2015. But this consolidation phase is getting ever so tight. So I think ultimately bonds will break either direction, either to the upside or to the downside. I think that could also have an effect on stocks ultimately. So you want to be prepared and a little bit hedged for this. I'm not saying that whatever move in bonds will happen will take the stock market down, but it likely could cause a little bit more volatility, or at least a more dynamic market here as we head into September and October period. Last but not least, gold has been doing some funky things here over the past few days as it sort of meandered back towards the lower end of its trading range. I do think the intermediate term, multi-month, multi-quarter trend remains higher in gold, and I'm looking to buy gold personally on the next bullish reversal. We have not yet seen one, so I remain absent on that trade. But that's the thing, guys. I want to make sure folks know, please don't get complacent right now. I know it's easy to get complacent. Late August, summertime is slowly coming to an end. A lot of people are still taking their last vacation. Markets right now this year are very quiet, but I think this is exactly the best time to start protecting yourself a little bit for September and October. And the best way, in my opinion, to do that is to buy some S&P 500 puts that are very cheap right now, particularly with implied volatility being very low. So I hope this helps, guys, and enjoy the rest of your week.